Hey guys, and welcome to our fourth seminar on oil and gas accounting. This one is centered around revenue recognition. While this seminar was directed towards auditors, much of the language around risks and audit procedures could be utilized in controls or how someone might know that what they did was correct, how they know those numbers are complete and accurate. Stay tuned, our next episode is on the reserve report. If you learned something new, please like, share, and subscribe.
To go over like the oil and gas revenue, we're going to look at not only the product types, because gas and NGLs all have different hydrocarbons and therefore different subproducts. But we're going to go over the pricing, the over/under differential, operator versus non-op, because those people will account or get revenue information separately or in a different manner. And not to mention the most important part of the royalty interest for the people that, the landowners collecting the paychecks. Both be going over the DOI, kind of like we'll go over some examples of the revenue testing and accruals because of the manner of, we'll go into further detail, but because of the nature of revenue and the timing of processing, there is a big accrual at the end of the year for December production. So just to go over the product types, the one that everyone should know is crude oil. This one, just to kind of go over the nature of it, but this one's going to be a liquid at natural pressure. It's what's going to be, it's what everyone thinks of first. It's the one everyone thinks of first when it comes to the oil and gas and the oil and gas business. Not every single oil out of the ground comes out the same, as some will have different byproducts or different, subchemicals that need to be refined. Therefore, you have different quality indexes, which is part of the differential we'll get into. Natural gas, when pulled out of the ground, is going to be a gas at normal pressures and will be liquid at high pressure. This, more or less, natural gas and NGLs, these are going to be combined, and they're not going to separate naturally out of the ground. You'll have to take that to a processing plant to get that wet gas or NGLs out of the gas, so you can sell them separately. Products like propane, butane, and isobutane, part of the NGL grouping, has market surplus over natural gas, so it is cost beneficial to extract those out when you have a certain amount of NGLs. Some calling and volume matrix. We mentioned this earlier in the reserves, but oil is commonly in barrel and makes up 42 gallons. This also makes up 6 MCFE, or cubic feet, 1,000 cubic feet equivalent. Oil volumes are typically sold in what you'll call batteries. This gives an example of lease tanks, but batteries is what they're normally called. And they're basically like huge storage tanks that the production is held in for the trucks or railroad or any kind of manner in which the oil is sold can pick up and bring it to the end purchaser. Gas has several different volumes. Now, if you look at MCF, MMCF, these are all basically the same cubic feet measure. It's just thousands placed, millions, billions, and trillions. So the most common one you're going to see is either MCF or MMCF, unless you're dealing with like ExxonMobil or something like that. Now, as far as revenue goes, because of the wet gas versus dry gas nature, you have something called a BTU or an MMBTU. This is going to cause, this is basically a unit of energy or a calorie. It's sold, it's basically, it's an energy output measure. The reason why gas is sold primarily on MMBTU is because an MMBTU is an MMBTU no matter what. At the end of the day, the pressure base or anything like that goes. If you have high pressure, a gallon is not always the same gallon. So it makes sense to sell it on energy output, especially if you don't extract those propane or bentanes out of your gas. Therefore, higher gas ratio or wet gas is a premium gas, or maybe they just didn't extract the NGLs out. Prices for oil and gas, not only is, I have some examples of how this is calculated, but it's not just a market price per product, because NGLs, propane, bentane, all of that has their own indexes. It's going to be a nature of what it contains, what is it, and also just geolocation, West Coast or versus Houston Ship Channel. Each processor, each market has their own regional demands. These are going to be accessible through EIA.gov. Just to kind of show you what this looks like. I'm pulling up the. So over here, you're going to have, this is what the EIA.gov site is. This is what you're going to use for your differentials, for your reserve report. And you can see this is from the natural gas perspective. So it's really easy to find, just EIA.gov. So just to go further, for oil, it's not only just a geological location, but there are something is a quality index called sweet or sour. Is there, carbons in there that need to be refined out? Is it high? Does it need high levels of refinement, or is cost per refinement going to be low? If it's low cost to refine, you call it sweet, and that gives you a market premium. Okay. Here's an example of the general calculation for oil differentials. You have your normal NYMEX WTI pricing index. This is going to be straight from your EIA.gov. When you go through the pricing contracts, majority of the time they will have either a rolling month average or a 2/3, 1/3 roll. This basically just means that in EI.gov, there are several contracts, like feature contract 1, 2, and 3. This is just to smooth over the effects and differences between those subcontracts. But it plays into your market, your deduct rate, and your overall quality differential. You can see the Argus and the Houston differential. That's your quality index. The oil in that area is sweet, therefore these are going to be your market surplus factor when it comes to calculating your price. On top of your bonus can be negative or positive depending on that month average or roll factor that we're talking about within the future contracts 1 through 3. But also you have a deduct rate. This is your processing rate or your delivery rate. So you start off with your gross. You mark it with the 2/3, 1/3 roll, and quality gives you your gross. You have your bonus factor and your deduct rate that gives you your over or under your market value. In this case, the deduct rate surpassed the bonus factor. They're both negative, so you have a overall negative net price from gross. A little bit further too, with NGLs having several products, just like oil, you will have a quality or a market price bonus factor. Same with NGLs. For every single subproduct, this is an example of a schedule. This is pulled from the client's Bloomberg terminal. But you can see every single one, these are in cents, but every single one has a pricing over per gallon and with the overall effect being for propane, there's a 49-cent positive effect, and butane 54 cents. With each each additional carbon in the hydrocarbon chain, it normally gets you a pricing bonus.
All of that can be a little bit complicated, so let's take a look at a map to better explain this. Let's assume that there's a central hub in Louisiana called Henry Hub. At this point, they are selling gas for $4. Now let's assume that you are drilling out in West Texas. You wouldn't expect to get that full $4 for the product that you made out in West Texas. Things such as quality or transportation costs could impact that price that you receive at the wellhead. This price difference is called your differential. It is the price that you are paid for at the wellhead versus at the Henry Hub for a certain quality of product. Each well will have its own differential, but typically the field has a similar differential.
To go back to the slides, operator versus non-operator. Now, when you think of oil and gas from operator versus non-operator and the landowner perspective, there is a cost of the operator getting the land. The operator is going to be the person that usually has the most working interest, the primary decision maker. They're going to be responsible for the operating and maintaining of the properties. They are the key decision maker on what's going on. They're going to be the ones putting out bid for gas and everything like that. We made further examples earlier in the presentation about cash calls. These cash calls and, drilling costs and all going to be managed by the operators, while the non-operators, they are responsible for their respective share of their working interest. It's usually smaller, and the NRI is normally smaller, but they will be subject to the operations of the decision maker. Royalty interest is the important part. This is where you can think of the landowner getting rich. Now, in Texas or in any other state where you're allowed to own mineral rights, you by nature own 100% before an oil and gas company gets their hands on your lease or your land. You have 100% of the working interest and 100% of the royalty interest. But what you lack is the expertise. You have all this, you have the rights and the earning potential of everything under the ground, but you don't know how to get it. So the oil and gas company will come to you with expertise and say, I will take 100% of your cost or your working interest, and I will give you or let you keep 1/8, 2/8 of your royalty interest, percent of your royalty interest. So the landowner basically gives up their entire expense rights and sits and collects a smaller portion of their potential revenue. But in that regard, they lose the risk factor. There's no risk for the landowner. So these are going to be done by contract. They're not going to be subject to the normal billings of drilling costs or cash calls done by the operator. Since you have to factor in the royalty interest and they don't have working interest, you're not going to pay and earn the same amount. Just because an operator owns 100% of the working interest doesn't mean he has 100% of the royalty interest. You have to factor in that the landowner and him sitting back and collecting those checks. So just to go further into some pieces, the division order, the revenue testing and accrual, it's going to pick up on some of these pieces, but I'm going to just introduce them. So your division order or your D of I or your deck, you've heard it called a couple of different things throughout this presentation, but this is basically your agreement. What did the operator take or the non-operator take from as far as working interest goes and how it plays out with the royalty interest? A good way to think of this division would be like a partnership. but every single well is its own partnership. If you have, two people own a company and one is a 70% owner and the other one is 30, you would think in your mind that the expense, the revenues, and everything related to that company and the ownership of that company is split between the two. The same kind of application goes for these wells and these division orders. And because there's a lot of money around, and all wells aren't cookie cutter when it comes to royalty interest, there are significant agreements and division order, drilling order interest, titles, all these things that we have as evidence of ownership of these mineral rights. For the operator, because a purchaser is not going to sit there and chase down the rabbit hole of who owns what interest, because when a well first starts, there may be one royalty interest owner, but I pass away and I give my rights to my kids and then my grandkids and all this stuff. A purchaser is not going to chase down the grapevine of everyone. So what's important is what they do is they hand all payments and expenses go through the operator. It is the operator's job to allocate it out, pay the respective royalty interest owners their portion of revenue, and allocate it out. So allocate it out based on agreed upon interests. And when you're testing this D of I, because D of I will affect reserves, affects ARO, affects expenses, LOE, and everything basically around oil and gas, everything is signed and cleaned by to represent ownership. There's also several different kind of legal documents and that we can use to agree the interest they say they own versus the interest the drilling title opinion says they own. And these need to agree. So an example of some working interest in NRI. Like what we were saying, just because your operator, in this case EMP Inc., on a glance looks like they would be the operator because they hold primarily a majority of the working interest, while Bluebell is going to hold a minor or a lesser interest. Because you have to factor in the landowners, they don't own, it's not a straight 60-40 split when it comes to the revenue. The royalty interest owner, them giving up their rights to their rights to the land or their rights to the expenses at a cost to the oil and gas company says that they don't pay anything, they're just going to collect 12.5%.
Let's explore this example a little further. Let's assume that it cost $1 million to build this well. We would look towards the working interest to determine who pays that cost and at what percentage. In this example, EMP would pay 60% and Bluebell would pay 40%. The others would pay nothing. Now let's say that first revenue came in at $100,000. Each party would get their portion of the revenue based on their net royalty interest. Hopefully that helped. Now back to the seminar.
So again, with the division of interest or DEC or D of I, you're going to hear it called all those things. There are master files that contain the interest sharing percentages for all distributions. These are going to be, the master files will not only identify the lease and the month or when it was sold or who the purchaser was, but it can also contain, pooling versus non-pooling, or are there multiple landowners coming together to make up one big landowner or one big ownership. Maybe the acreage, they only own like 1 acre per landowner, but together they make this group or this pooling interest makes up 1,000 acres. It can be multiple people making up one subgroup of ownership. So with that, not only revenue interest can differ between working interest or overriding royalty interest. Overriding royalty interest it is normally very small. It's not common in every single well. Not all wells have to have the overriding royalty interest or the ORI. the royalty interest is going to be a part of every single well, because the whole point of drilling a well is to make the money. Excuse me. And because of, kind of like we were mentioning, because DFI impacts every single aspect of the oil and gas company, the reserves, the revenue, the expenses, what you are allowed to capitalize, literally everything. Any kind of miscalculation in ownership will grossly miscalculate your revenues, your expenses. And so it's important not only for us to test it, but it's important for the oil and gas company to get it right. We need to ensure that the revenue is being properly recognized, that there's not a miscalculation, allocation of capital costs, and liabilities and accruals are appropriately accounted for. So again, just to kind of go over what we need to do to test this, we need to consider how to get the deck out. How do we get the DOI out of their system? It's not going to be. It's going to be by ID number. It's going to be by a well or however it is in their system. We need to figure out how to extract it, because one landowner can have interest in multiple wells. It's not 1 acre equals one well. It can be multiple, just depending on the geological formation below them. So when we make selections, usually going to be by IPE, we need to make sure that we go from the well selection, the well listing, to what is actually owned. Where is the signed documents? What's showing your interest? Does that interest agree to the reserve report? And does it agree to what you're actually using to allocate cost? Through this, you are testing the validity of revenue, your LOE, your capital expenses, and your reserves. I do have an example. So without going deep into how it's calculated, gas is going to be sold on nominations. And nominations meaning, because there's NGLs baked into those gas, it's not known exactly the exact volume that you're going to get. What you get instead is a bid. So this is an example of a confirmation between the client and South Cross, a well-known purchaser, oil and gas purchaser in Texas. They're basically telling them, I will sell you 1,000 a day. In the little boxed area, you can see that it's 1,000 a day for a base load of IF, meaning inside FERC. I will go give you an example of the difference between inside FERC and the GDD of gas daily, but the plus is that differential. They're saying, I want to give you 1,000 barrels or 1,000 MCF a day or MMBtu a day at inside FERC plus 1.5 cents, and swing price at gas daily plus 1 cent. An example of an invoice here is right here. This has both the inside FERC and gas daily. When you see something like this where it says 1 through 30 for a given amount plus at a market price for an amount, that is your inside FERC. Inside FERC is going to be a market average for the month, whereas your gas daily is swing sales. You have on a given day, what did we sell? You sold dry MMBtu at the 5,000 a day every day at a swinging price. You can see for every single day in this Fasken area, the price goes up and down with the given market. And through that gets you your differential for oil and gas.
So we're going to start with a general understanding of an E&P company that is producing revenue and what their portion of that revenue would look like. To get started here, we need to remember that a well that is producing revenue can have multiple interest owners and that the E&P company's portion of that revenue corresponds with its net revenue interest. So what does that mean? It means an E&P company's revenue is the revenue amount net of royalty interest, overriding royalties, and other revenue interests held by others. Those royalties are the interest owners that don't have any obligation to carry out any exploration, drilling, or production activities. So they bear no part in the costs incurred from production except for their proportionate share of the production taxes. The lesser share of production is typically in increments of 1/8, 1/6, and 1/4. Next, the overriding royalties, abbreviated ORRI, are interests that have the right to receive revenue from the production of oil and gas wells. The main difference it has from the royalties is that it's carved out of the working interests from the E&P company's share of the production. It's not an ownership in the minerals, but in the proceeds from the sale of the oil and gas. And it's tied to the oil and gas lease. When the lease expires, so does the royalties. And lastly, the revenue interest held by others refers to production payments and net profit interests. Production payments obligate the grantor, in this case the E&P company, to pay the holder a specified portion of production proceeds or deliver a specific amount of oil and gas before production stops. Like the others, there's no obligation to pay operating costs, and this is commonly used for an immediate receipt of cash. The transaction resembles a financing agreement whereby the company pledges production or proceeds from production to collateralize the repayment of the funds in advance or the funds advanced. And that brings us to the net profit interest, which is an interest in production that is created from a property's working interest. It is measured using a stated percentage of the net profits from the property. Holders are never obligated to pay a share of the losses. However, the net profit may be considered cumulative and incorporate losses from prior periods. The NPI is similar to ORI, but is measured on net profits and not revenue. And then moving on from the terms, we can talk about the entry that is made to record revenue.
We actually did have a question about division or D of I, so just want to touch base on that. The question was why we have concern over the ownership order. It's if I'm getting that question, I guess it's less of the order. It doesn't matter what order if it's greater than or less than. It's not the order of the interest that matters, if I'm understanding that correctly, but it's more of who owns what. Because if the operator or the person holding the keys to the well, holding all the decision making, gets all 100% of the revenue and pays 100% of the expenses, they basically they're paying and getting money on the behalf of the people that own other percentages. Therefore, they're collecting 100%, but not 100% of it is theirs. So, in the example we gave earlier, the operator had 51%. So they're getting 100% of the revenue from the purchaser and the sale of the production of the well. They're holding it, but only 51% is theirs. Therefore, that 49% remaining is a payable. It's a liability, and they need to distribute that to the respective owners because it's not theirs. Same with the expenses. In the example we gave, it was 60-40. 60%, he owns 60%. The operator owns 60% of the expenses, but they're paying 100. Their partner or non-operator in the well owes them money, so they're going to have that 40%. The remaining 40% that is not their liability as a receivable. It's theirs. They are owed that by their partner. Does that answer your question?
Yeah, and I think they'll see that a little bit in the next slide when we get into the entry that gets made there.
Oh, perfect. Sorry, jumping the gun, but I just wanted to answer that question.
You got them warmed up there.
Perfect.
And so, moving from the terms that I was just talking about, we can talk about the entry that is made to record the revenue. An operator records the full receivable, and by the full receivable, I mean the total amount from the purchaser, which would include the company's interest as well as other interests. The company receives the full amount because the operator is responsible for distributing the revenue to the revenue to royalty and other interest owners. By industry standards, there's typically a 1 to 3 month lag for purchaser statements and payment. Non-operators typically receive oil revenues within 2 months and gas and NGLs within 3 months. And so, on to the next slide. Here we have an example of a typical revenue entry. So E&P company is an operator and holds a 30% NRI in a producing well. Oil sales for the month of June 2021 were $100,000 with 10% production taxes owed to the state. The necessary entry would be as follows. So we got a debit to accounts receivable, oil and gas sales for $90,000, a debit to production taxes for $3,000, credit to oil revenue for $30,000, and a credit to revenue payable for $63,000. So to talk about that a little more, as we talked on the previous slide, an E&P company's revenues are its share of revenues net of the royalties, ORI, and excluding revenue interest owned by others. So for this example, gross revenue from the oil production is $100,000 before a 10% state production tax, and the E&P company's net revenue interest is 30%. We get our credit to revenue by multiplying the $100,000 by the NRI of 30%, giving us a total of $30,000 as a credit to revenue. And then we take that 10% of the $30,000, and that gives us the $3,000 debit to production taxes there. So if the company receives the full $90,000 of revenue proceeds, which is net of production taxes withheld and paid to the state, it keeps a net $27,000 and must distribute $63,000 to the other interest owners. And so that's what James was talking about a second ago with the distributing those other interests. So in this case, the purchaser is deducting taxes from the sale proceeds and paying the E&P company a net amount, which is why the receivable is $90,000. The E&P company ends up with a net $27,000 in revenue while being responsible for distributing royalties of $63,000 to interest owners. And so also to briefly discuss the revenue payable here, payments would be made by the E&P company, usually monthly, to the royalty owners in the form of a settlement statement or check stub, also called a remittance advice. The document will identify the leases involved, month covered, volume, sale price, royalty, owner percent, production taxes withheld, and the net amount paid to the royalty owner. And so I'll share my screen real quick and pull one of those up.
Yep.
Okay. So here, this would be one of those non-op statements here. And so on here, we'd see the months, we got the type, we got the severance taxes here, we get to the net amount, we got the owner interests. And so this is what I was talking about a second ago that would be sent to those royalty interest owners, every month or so. So stop sharing there. And then lastly on this slide, since I started talking about the revenues payable a little bit, I should mention that it's not always easy for the company to find who paid. At times, revenues may be held in suspense and not distributed for various reasons. The ranges of these reasons are fairly wide, but it basically boils down on not knowing who to pay. But, it could be awaiting an executed division order, waiting, signed change in ownership proof of title, or there could be some type of dispute or anything like that. And so what happens with these dispense amounts is eventually when the owners are not known or can't be located, amounts due are required to be paid to an escrow account. Outside companies may be engaged to find the owners, and their fees are charged against the proceeds. So those owners' proceeds. After a period of time, revenues held in suspense accounts are distributed to the appropriate state agency. So the purchaser statement. The purchaser statement or revenue remittance is received by the company from the purchaser. Like the non-op statement I showed y'all a minute ago, the purchase statement includes all of the leases or wells being paid, the production months covered, and the type of product. It also includes like the sales price, the individual products, company's interests, and all the state tax withheld and or production tax withheld, and then the net amount paid to the owner. So these purchase statements are very important for obvious reasons here, but they will feed directly into what the company is recording. And so for that reason, once the statement is received, it is reviewed by the land department, who will compare the statement to their internal company records of volumes sold. The prices, tax rates, and NRI will also be reviewed at this stage. There's typically close interaction between the production, land, and marketing departments to assess the appropriateness of the information for an accounting entry. So this is kind of where they just true up with what they have internally and what they're receiving from the purchaser, just to make sure everyone, I guess, is on the same page there. I have an example here of a purchaser statement. So this example isn't nearly as pretty as the non-op statement I just showed y'all. These purchaser statements can look very different company to company. Like the one I showed y'all before is nice and organized. This one I have here is not. So pull it up, share, and then. So this is what this one looks like. I got this for this company. Their purchaser statements came back as Excel documents. And the main thing here is that it has all the information you need. The date, it's got the product, the NRI percent, the interest percent, the barrel of oil. We got the price, and then we got I guess this will be the net amount here without the taxes, which we have over here. That gets us to our net amount. So, like I said, some of these aren't very pretty, but they have all the information you need. So when you're testing this stuff in the revenue testing, especially if it's a first year, you really need to work with them to figure out what it is you are looking at here. So let's stop sharing there. And a lot of times, since we use the portal now, you can go back in and look at purchase statements we received in the prior year, and then vouch one in the prior year, and that can help you out figuring it out. So the next slide. So risk with revenue here. Over accrual of accounts receivable and revenue would be the first risk that comes to mind. This risk, as it pertains to our audits, is a risk specific to the revenue accrual, covering the last 2 months of the year. Due to the manual nature of the revenue accrual process, specifically, an E&P company must estimate production volumes and realized pricing to input into the accrual, which could lead to a mistake due to fraud or just human error there, or error in the inputs. So due to the month's lag on a purchase statement, recognizing revenue in the appropriate period too is always a risk. Another one with improper allocation of interest, it means there could be an error in the DOI. So a risk exists that the company is not using the correct ownership interest when recording revenue, expenses, and CapEx. Or it could be there was a wrong interest on the purchaser statement that was not caught by the company, resulting in that review that we talked about a second ago. But that would result in the company making incorrect entries. Another risk that came up a ton, particularly in our audit of year-end 2020, was collectability of accounts receivable. Due to COVID, the lack of demand resulted in low oil prices, and there were plenty of bankruptcies in the industry, which in turn made more of a risk that, some of the companies that we were auditing's AR balances would be, there'd be a risk with collectability there. So due to the above-mentioned risks, as well as others, there's a presumed fraud risk in revenue, and it's generally considered a SRMM due to this inherent risk. Fraud risk can be overcome on a client-by-client basis. Some reasons that it can be overcome are if there is only a few wells, if there are only a few operators or purchasers, if the company uses a non-operator model, or if there's no estimation involved in the revenue accrual, or other reasons such as this. The slide here basically lists out step by step how to do our revenue testing. So it starts out, the first step here is we receive the TB, the LOS, the revenue detail, and the first thing we're going to do is we're going to make sure all those things agree to each other. Because we can't really test revenue if can't detail test revenue if the population we have isn't going to agree to, our trial balance and our LOS. So that's the first thing we do here. And then after we agree the population to the TB and the LOS, we can get to work with the revenue detail. The detail can oftentimes cause problems to manipulate due to its size. So just a heads up, I'd recommend saving whatever Excel spreadsheet you have open before you start working in there, because you're basically sorting the revenue section of a GL here. So it's a pretty big file generally. But what we're going to do to the population is we're going to clean it up, and what that involves is removing in and outs, which could be accruals that are reversed when it's trued up to the purchaser statement. And then if debit entries are material, we're going to take those out and, we're going to test those separately. So the third step here is to make our sample. Generally, I've used an 840, but, you can do some attribute testing. And then that's where, we're getting into our vouching. Is the fourth step here. We're taking the purchase statement we saw earlier, vouching to the volumes, price, dates, and all that good stuff. And after we vouch all that information, we then, have to agree the interest that we see in there to our DOI or our revenue deck. And then after all that's done, we need to tie what we received to the bank statement. A lot of times we're, testing at a line item level. So you're going to have to get into the whole purchaser statement and look for that number. And sometimes multiple are paid at once. So that can be a chore from time to time, but that's, you normally can get the client to help with that. And then the test for completeness of revenue is separate from the above one. Typically for this test, we use an IPE to come up with a population size, as the selections from this test come from the reserve report. The test is simple. We select some wells from the reserve report and we make sure that they're in our revenue detail. And then the test for revenue payable is its own test separate from the two above. In the past, I've generally been able to do a simple SAP for this FSA, as it should be a consistent percentage of revenue. So now we can go a little deeper into the accrual. So the revenue remittance is generally on a 1 to 3 month lag. From what I've typically seen. It's 1 month for oil and 2 months for gas for operators. The accrual estimation process varies company to company. If the audit is right after year end, what you could see is an accrual based off of the previous 1 or 2 months production, where the company uses an average of that to come to the expected production for December, and then multiplies it by an expected price. Let's see. Or if the audit is a little later, the production department could be able to supply a current volume information for operated wells from internal reports. For non-op wells, they would have to estimate based off historical production. When the company is making these estimates, they are also doing that for the production taxes and other deductions, as these accruals are based off a percentage of the revenue accrual. And the company will adjust these accruals as the actual information is known. So the accrual will be adjusted the further out you get from year end to actuals there, if we're doing the audit there. Go to the next slide. So getting into the revenue accrual risk, as I've mentioned on a previous slide, on E&P engagements I've worked on, the revenue accrual has been a significant risk. The main risks we come across are listed on the slide there. Over accrual of revenues, unreasonable price or volume component, completeness, existence, and accuracy, and management estimation process. The over accrual of revenues is one of the foremost problems we look for. If you look at the other 4 on the list, the outcome of those scenarios would typically lead to an over accrual. The unreasonable price or volume component typically can be seen when a client uses a price that is higher than what would be expected. However, in some cases, I've seen a client under accrues, staying on a conservative side, and prices jump unexpectedly. And the same would go for volume here. So that's something that is a risk there. As for completeness, existence, and accuracy, those are generally risks that come with any accrual. Lastly, management estimation in the process is a risk. There's always an opportunity for either error or fraud there. So the next slide. So some procedures here. So now we're into the audit procedures for the revenue accrual. Intuitively, you would probably think to send out confirmations. However, historically with oil and gas audit engagements, these confirmations are not typically returned by industry participants. Mainly this is due to the nature and volume of the receivables, i.e. numerous different working and revenue interest owners are typically associated with each well, and entities may be involved in hundreds or thousands or such wells. So because of that, the use of confirmations would be an ineffective procedure in testing the reasonableness of AR. There are a few different procedures that can be done, though, to test the accrual, and what you can do is dependent on when it takes place after year end. So a procedure that is used a lot is bucket testing, where you run an 840 and you can vouch to post year end receipts. We can also recalculate the accrual calculation. For example, I had a smaller client engagement right after year end, and we were able to recalculate the company's accrual based off the internal production. We reviewed the meter tickets to get comfortable with production. Then we multiplied by the average price during the month to get to the gross revenue. We then had an ownership interest for the company in royalties and ONRR, and used the state rates and severance and ad valorem, and we were able to recalculate the accrual pretty closely there. And then if the engagement is far enough after year end, the accrual testing can be done pretty similar to revenue testing. You can just do some vouching there. So for the next slide. All right, so now let's take a look at the various taxes. So for production taxes, most states levy one or more type of tax on oil and gas produced in the state. Production taxes also is called severance taxes and are computed on the basis of volumes and or volumes of oil, condensate, gas, NGL, and sulfur produced and sold or consumed. Taxes are usually levied at the time and place that minerals are pumped from the well. Another tax imposed on some states is a conservation tax used to fund energy conservation, oversight, and research programs. Many Indian tribes assess a production tax, which is usually credited against the amounts otherwise due to the state where the well is located. And each tribe and state varies on the assessment of that. Typically for production taxes, there's this easy SAP as it's based off a percentage of revenue. If for whatever reason the SAP isn't possible, you can always test the severance taxes similar to revenue as it's on the purchaser statement. And then ad valorem taxes are generally levied by counties, school districts, and other taxing entities based on where production occurs. Ad valorem taxes can be based on either the level of production occurring in the previous calendar year or the estimated fair market value of well equipment or economic interest in the property. Tax rates vary widely among local taxing entities, and county or parish may encompass many different taxing entities. Ad valorem taxes are similar to production taxes in terms of calculation, meaning they both have a statutory rate to the gross value of production, which means you can SAP them both there. All right, audit risks. The risks surrounding production and ad valorem taxes are similar to those of the revenue. Instead of an NRI like revenue has, these taxes have rates that are based off of whatever area they're in. So those rates need to be right to be able to for the production taxes and ad valorem taxes to be accurate. There's not really much else to add there. So on to the next one. So audit procedures. So as mentioned above, there are some pretty easy SAPs that can be done on production taxes and ad valorem taxes as they have a known rate that is based off a company's production. The easiest example of a SAP is for a company that is producing in one state because there's less entities you have to deal with there. The steps are you get the revenue off the LOS, go to the state website and verify the severance and ad valorem rates or whatever applicable rates there are, and then you just multiply it by the revenue. But if you don't want to do a SAP for these expenses, you can also 840 and vouch the production and then production tax. And then for ad valorem, a lot of times you can just vouch to supporting invoices from tax authorities. I have another example here for the SAP I was just mentioning. So where is that? So this is tax or a SAP that has the severance tax, conservation, ad valorem. So we get the revenue from the LOS here, and then as you can see by the tick mark, we went to the Wyoming website and got the different rates here. Sometimes it takes a little while. You have to look at a lot here. But we got to the rates, and then we can just multiply it out, and we came to an immaterial difference down here. And as you can see for the ad valorem, we were able to tie that back to push year-end payments. So that's a fairly easy SAP that should be able to work a lot of the time.
The other thing to consider with severance is, depending on the state, they will tax oil and gas separately at different rates. Maybe oil lower and gas higher. So if you're messing up this happening, you're like, wow, it's horribly off. Make sure you're current with the state's laws, like Texas, for instance. Gas and oil are taxed separately. So just check, and if they are majority gas or they're majority oil, you should reflect your expected percentage to be more or less a weighted average of the two. If they're 50% gas and 50% oil, maybe it should be the middle of the two percentages. Change your expectation based on historical, and you can document that.
Yeah, for a lot of these SAP, like James just mentioning, you kind of got to think a little bit on them. Mine, like I showed you, was just an easy one I thought would be good for an example, but that is almost all oil production, and it's all at the same rate. You just, you think about it, you come up with something that's good, and then you just have to document how what it is you're doing. So additional considerations here, we have ASC 606, special royalty provisions and allocations. So as a general overview of ASC 606, in May of 2014, the FASB issued accounting standards update to 2014-09, revenue contracts with customers, topic 606. The new guidance establishes the principles to report useful information to users of financial statements about the nature, timing, and uncertainty of revenue from contracts with customers. So the new guidance removes inconsistencies and weaknesses in existing revenue requirements. It provides a more robust framework for addressing revenue risk or revenue issues. It improves comparability of revenue recognition practice across entities, industries, and jurisdictions, and provides more useful information to users of financial statements through more disclosure requirements. So the new guidance affects, I guess it's not really a new guidance anymore, affects all reporting organizations that either enters into contracts with customers or transfers goods or services. By now, our clients have adopted ASC 606, and it's our job to examine that, implementation. Typically, how this would work is we would request the client's revenue contracts and also request a memo from them documenting their implication of 606. On our end, we would then evaluate the revenue contracts by completing a risk identification checklist and a revenue recognition workbook. What we are trying to accomplish there is identify revenue streams and apply it to the 606 framework, which is 5 steps, which the first one, identifying a contract with the customer. So making sure we have a contract, identifying the different performance obligations, determining a transaction price, allocate the transaction price to performance obligation in the contract, and recognize revenue when or as the entity satisfies a performance obligation. So after completing the workbooks that I talked about, we write our own memo and we assess the implementation of 606. And then we also will implement side by side this with our revenue testing. So generally with the revenue testing I showed you, at the end of it, we will see for whatever selections we have is that selection from a purchaser statement that has an applicable contract, are we meeting, is there a defined performance obligation, and all of those different things. It's a pretty time-consuming process, especially in that first year. It's a little little easier now. But for first-time implementation, it can take a little bit to get going.
So here's an example of this is the amended contract with Shell. You can see, right, they have what is the product that this is for? This is for oil. They have the quantity, equal to 100% of the production for every, listed leases and the terms of delivery. But you also have certain things like the differentials that we're speaking of. Like they say, here's the price. Price is index, plus or minus the arithmetic of the 2/3, 1/3 roll, quality index, and the base price of the NYMEX. So they go through how to calculate the differential in the contract, and this is how we should calculate it respectively. They go over payment terms, and you can even see alongside those bonus factor and pricing factor is the deduct rate. So here's a list of wells that they say all oil that's made from these wells, give to me. But they're also saying we're going to charge you $3.75 per barrel from these wells as a production fee. And that's basically an updated contract. You can see that it was when it was effective June 1st, 2020. This is an older contract, and it usually will be in place for months on end.
And move to the next one. So here I have some special royalty provisions. We've talked about override royalties, but to reiterate, these are royalty interests created out of the operator's working interest. Then there's shut-in royalties. These types of royalties can come into play when a well is shut in, even though it is still capable of production. This can only occur after proved reserves are discovered, and it is typically included as LOE. And then guaranteed minimum royalties. This is exactly what it sounds like. The leaser will receive a minimum royalty each year, regardless of the amount of production or current price. And then to wrap it up here, the last slide we have is for allocations. Product produced by an E&P company can be purchased at a field level, at a tank battery level, which would consist of multiple wells. The total volumes from these levels could agree to the purchase statement, but the allocation of the total production must be able to go back to the individual well level. The reason for that is that not all wells in the field or tank will have the same NRI or ORRI owners, and accurate measurement is needed for each. Allocation schedules are maintained and agreed back to the field and the tank batteries. So that's all I got here.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.